Hello, Accounting 2 students. This is Mr. Johnson. Today we're going to talk about Chapter 19, Section 1, the ownership of a corporation. So what you will learn is which equity accounts are used in corporation accounting, how equity earned through business profits is reported, and which end-of-period financial statements are prepared for a corporation. Okay? So, recording the ownership of a corporation. Capital stock, that is your new account. That represents the investments in the corporation by stockholders or the owners of the company. Now, stockholders can range anywhere from one individual owning all the stock in a company to thousands of people owning stock in a company. So it's not one set rule on that. Capital stock. The account capital stock is classified as stockholders' equity account. Okay. So let's just take a look from your experience in Accounting 1. You classified or you established the sole proprietor. You would write down Maria Sanchez Capital as your account. Okay, so let's do that. So let's put in here Maria Sanchez Capital. Okay, now as a corporation, what we're going to do is we're going to list this as capital stock. Okay, so moving on into Accounting 2 and the merchandising business or the corporation, we're going to list this as capital stock. Okay, so there's the difference between the two. All right, moving on, let's take a look at a transaction. So on January 1st, you have this transaction where stockholders invested $25,000 in exchange for shares of stock of the corporation, receipt 997. So how would you write this in a T account? How would you write this in a T account? So go ahead, take a second, pause, write it down. All right, so the way you would write this down for this transaction would be your cash and bank account, your asset account, is debited or increased by $25,000, and your capital stock account, your stockholders' equity account, is also increased by $25,000 with a credit. All right, so now how would we journalize this? Take a second, think about it. How would we journalize this? All right, so very basic from your experiences. You would take this transaction in a general journal, and on the first line you would put in the year. The second line you're going to put in the month with the day, and you're going to align to the left your debit, which is cash and bank, and you're going to put in the debit amount in your debit column, $25,000. On the next line you're going to take your credit, which you're going to indent. Okay, that's capital stock, and that's credited $25,000. And on your fourth line you're going to go ahead and put in your source document, which is your receipt. You're going to indent that even more and receipt 997. And that's how you would go ahead and journalize this transaction. So what is stockholders' equity? Stockholders' equity is the equity or the money that's contributed by stockholders. It is also the money or the equity that is earned through business profits. And we're going to use another account called retained earnings, which represents the increase in stockholders' equity from the portion of net income that we do not distribute to our stockholders. The money that gets distributed to stockholders are called dividends, which we'll talk about in a later chapter. But just for our purposes here, retained earnings is another account that we're going to use, and that's the money that we retained within the business. All right, so retained earnings is listed as a stockholders' equity account, okay, and I'll just use this right here as the T account, okay. And our debit obviously is always left, and our credit is always right. And how do we show our increases and decrease? Well, it's a stockholders' equity account, so we're going to increase on the credit side, decrease on the debit side, and our increase side is always our normal balance side. All right, so that is retained earnings, our T account format. So when I go ahead and prepare the balance sheet, as I did in a sole proprietorship, I'll just put SP. Okay, we're going to stop right there. All right, so when we go ahead and prepare the balance sheet, the sole proprietorship, the way you would do it is under the owner's equity section, okay, you were putting down the owner's capital, okay, like Maria Sanchez Capital, that's what you would put down, okay. In the corporation, what we're going to do in the corporation is we're going to go ahead and it's going to be under the stockholders equity section, stockholders equity. Okay, that is a section on the balance sheet. And you're going to have two accounts listed. You're going to have the capital stock All right, so capital stock. And the other one you're going to have is you're going to have retained earnings. So those two accounts are listed under your stockholders' equity section. And I didn't spell retained correctly, but you get the gist. Okay. Try to throw an E in there. All right, so retained earnings. All right, the characteristics of financial information. Financial statements. Financial statements are used by many groups. Managers use them to analyze the financial statements to help them evaluate the past performance as well as to help them make decisions going forward. Stockholders, they love to see how things are going as far as performance. Is there potential future growth and the overall success of the business? Okay, creditors, okay, they want to know the ability of the business and can you pay your debts if you could take a loan out. And the government, they certainly want to know what's going on, the IRS, et cetera. Your employees would love to know what's going on. The consumers, before they buy goods or services from you, are you a business in good standing? They want to know, all right? The general public is also interested just in terms of what is the position of the business, okay? Financial information, okay? Continuing characteristics of financial information. For accounting information to be useful, it needs to be understandable and comparable. Thus, for the financial reports to be useful, the data must be presented in a way that lets users recognize similarities, differences, and trends from one period to another. All right, so there's 5 characteristics: comparability, reliability, relevance, materiality, and full disclosure. And I like to try to think of it with this acronym, I guess, of C-RE-RE-MOD-FUD. Okay, C-RE-RE-MOD-FUD, which stands for that comparability, reliability, relevance, materiality, and full disclosure. So what is comparability? For accounting information to be useful, it must be understandable and comparable. Comparability allows accounting information to be compared from one fiscal period to another, essentially the matching principle. Okay? Reliability. Users of accounting data assume that the data is reliable. Reliability relates to the confidence that users have that the financial information is reasonably free from bias and error. Okay, so it needs to be reliable. Relevance. Not all information about a business is relevant to financial decision making. So we only need to include things that are relevant within our financial statements. And that means that the information makes a difference to a user in reaching a business decision. And full disclosure. To disclose means to uncover or to make known. Full disclosure means that financial reports include enough information so that the report is complete. All right? And the last one is materiality. If something is material, it is important, okay? And that means that the information is deemed relative and should be included in the reports, okay? And lastly, here's our 8 key terms: capital stock, stockholders' equity, retained earnings, comparability, reliability, relevance, full disclosure, materiality. I encourage you to use Quizlet to understand the key terms in the chapter and to help prepare for your Chapter 19 test. All right, good luck and good studying.